We now start our discussion on one of the major topics under financial statement analysis, which is essentially known as working capital for a company. So, working capital is going to be of paramount importance when we look at a company's financial statements and how they are managing the business. It involves some of the major headers, such as how does the company manage its receivables, how does the money come into the firm when they sell something, involves management of inventory as well, and also of payables. In addition, some other headers as well. But essentially, what is the firm doing about all these headers, and how do all these headers fit into the overall scheme of financial management, financial statements, analysis of the firm, is what is going to be the objective of this particular exercise, right? Before we move ahead, our first task is to essentially look at what is working capital and how do we calculate working capital as such, right? So those are the first couple of topics we're going to look at and try and understand. So let's first define working capital, and then we extend this analysis in terms of what is the objective of using a certain formula to calculate working capital, and what interpretations do we derive out of it, right? So working capital is the amount of money needed to be funded, right? The amount of money needed to be funded in order to run the business operations smoothly, right? Day-to-day business operations of the company smoothly. Now, the keyword here is funded, right? We will come back to this keyword in a moment, but just remember this keyword, that only the amount that needs to be funded is what is known as working capital, right? As a related question, if we discuss that current ratio of a firm increases from 1.5 to 2.5, you see that cash balances have not increased during the year. So what is a current ratio? Current ratio is nothing but current assets by current liabilities. We are saying this used to be 1.5, now this has become 2.5. That can happen if current assets have gone up or if current liabilities have gone down, right? Now, what should be the response of the stock price, the share price of the company? Should it treat that as positive? Should it treat that as a negative event, right? Now, conventional analysis tells us that current ratio should be higher. Higher the better. That's what conventional analysis tells us. But that does not tell us the entire picture, right? To understand the entire picture, we do need to ask ourselves some basic questions about, when we run a business, then what is it that we intend to kind of do with the business, right? Now, the calculation of working capital. So let's arrive at the calculation of working capital first, and then we will revisit this question once again to understand what is the logical answer that we should give to this kind of a question. On what factors does this depend, right? So to understand working capital, let's assume that I run a computer assembling business, right? So there is a set of suppliers who supply raw material at rupees 20,000 per computer, and there is a set of customers who buy the assembled computer for rupees 30,000 per computer, right? So 30 minus 20, 30,000 minus 20,000 is what is my 10,000, which is my operational or gross profit. I'm going to use this to run my business operations. Those business operations could include a variety of things like rent. They could include a variety of things like electricity. These are all the payments that I have to do, like marketing costs, like salary, etc. And then if something is left after all this, that comes to me as my profit. So that 10,000 basically takes care of all these headers. Let us assume a couple of things in our discussion. The first assumption I would want to make, and I'll write these as assumptions in this business. The first assumption I want to make is that this is a cash settled business. So I say that at the end of day, there is no receivable, there is no inventory, and there is no payable. So all these get settled day to day, right? So at the end of the day, there is no such data point that is available. The second point that we need to see is that just keep cash out of the discussion for the time being. We'll bring cash back into the discussion at some point of time. For now, just assume that this company does not hold cash, right? Just argument's sake, this company does not hold cash. So what is the current scenario? I buy raw materials for 20,000. I sell the computer for 30,000. In the process, I make 10,000. That 10,000 is used to kind of repay all the other expenses that I have. And if something is left out of this entire exercise, I make some profit. Everything gets settled every day. So I receive my 30,000 the same day. I pay my 20,000 the same day. And I'm getting all this and I'm repaying all these other headers also on the same day itself. So there's no delay in terms of any payment that we are doing, right? So that's something that we need to kind of ensure and become, comfortable about in terms of this entire discussion. Now let's see, in the case of running this business, what happens if on one fine day the customers delay the payment, right? So now the customers wants to delay the payment, and because they are long-standing customers, I agree to it, right? Which means at this point of time, there was supposed to be an inflow of 30,000 into the business, which has now not happened, right? Technically, if these guys have delayed a payment, this delay in payment should appear as an account receivable. Why? Is because I've already given them the computer. I'm yet to receive money from them. So that's an account receivable. That's known as a current asset, right? That's a current asset. Is there any payable at this point of time? At this point of time, there is no payable because I haven't spoken to my suppliers at all. So what is the situation? The situation appears as current assets now become 30,000. That's nothing but a receivable. And this is money that is now stuck in the business. Now, once this money is stuck in the business, it is my responsibility to somehow fund this, right? Somehow fund this. Remember, we use the term funded. This requirement of 30,000, this 30,000. So what am I doing? I'm using the formula of current assets and I'm seeing if there is any current liability. I subtract current liabilities from current assets to get what is called as working capital. Now there is a shortfall of 30,000. That's the working capital requirement. If I do not fund this 30,000 from somewhere, my business will not run as usual from now on. Either I will not be able to pay my supplier or I will miss one of the payments on any of these headers. Any of these headers, I will miss the payment: rent, electricity, marketing, salary, correct? So at this point of time, there is a shortfall in the business of 30,000, and this is known as the working capital requirement. That is why we use the formula current asset minus current liability, because this tells us what is the amount of money that is stuck in the business and that creates a shortfall and that needs to be funded, right? Now, how do we fund it? If it needs to be funded, there must be a mechanism of funding it in the first place. So how do we go about funding it? One of the best ways of funding it, or the easiest or the first or simplest ways of funding it, is you go to your suppliers and check with your suppliers if they are willing to accept the payment after a time frame, the same time frame at which your customers are paying. Can you pay your suppliers later as well? So you go and request to your suppliers to delay the payment for you, right? So you delay the payment and the suppliers, let's say, agree to it. The suppliers now agree to this bit, which basically changes this equation. The moment the suppliers agree to it, you have not paid money that's available now in your pocket. So you have, in a way, created a payable. So there was a receivable here, which blocked cash into the system. Now you have created a payable. What does that do? A payable essentially releases cash because you did not pay this 20,000. This 20,000 is available with you. You can use it elsewhere, right? The, the receivable, on the other hand, creates a scenario where cash gets stuck. It blocks cash, right? Now what happens? My initial shortfall was 30,000. I funded part of this 30,000 by current liabilities. So I go to my supplier and say, I don't want to pay you right now. The supplier agrees, which basically means 20,000 that was supposed to go out is now not going out. So that basically reduces my working capital requirement to CA minus CL. That's 30,000 minus 20,000, and that's 10,000. Even now, if I do not fund these 10,000, if I do not fund this 10,000, there is going to be a shortfall, which is going to either result in me not being able to pay my electricity bill or rent or salary or some other costs, or not make a profit, right? So business as usual still does not continue until I fund this 10,000. Now, what are the ways I can fund this 10,000? One of the ways is I can go to a bank and take a short-term loan of 10,000. If I take a short-term loan of 10,000, current liabilities will become 30,000. So 30,000 of current assets, and 20 plus 10, that's current liability, becomes 30,000, which leaves my working capital requirement as zero, right? There is a common error that we do while defining the definition of working capital, is that we say this is money needed for day-to-day operations. That is missing the part that this is money needed to be funded to run day-to-day operations smoothly. Otherwise, if it is money needed for day-to-day operation, in this case, working capital is zero. That does not mean this company needs zero for day-to-day operations. It only means that this company does not need to fund anything more. They've already funded it using 20,000 of payables and 10,000 of short-term loans. You can fund it using your own money and or a loan. At this point of time, we have assumed that the company has taken a loan. But there are repercussions of suddenly going to a bank and asking money, because the bank will charge a very heavy rate. So for this, you could have to pay heavy interest. May not be such a great idea, right? So now what can be done is we can use our own cash. If we re-include our own cash requirements, there is a shortfall of 10,000 that needs to be funded. I can fund it using the own cash balances. So I take out 10,000 from here. Once I take out 10,000 from here, automatically this 10,000 is taken care of. Tomorrow when my customers pay me 30,000, I will pay 20,000 to my suppliers, and I will input the 10,000 that I had taken out from my cash. So essentially, I can use my cash balances as well in order to use working capital. Now, this premise where I can use my cash balances in order to kind of uh, fund my working capital has long-reaching implications for the analysis of working capital. First part, any increase in working capital, is technically, by what we just saw, cash flow negative for the company. It will also be cash negative for the company. So first, it will create a negative cash flow kind of a scenario. Second, it will also take out cash because there is a negative cash flow. You have to fund it somewhere, right? So you will have a cash negative scenario if there is an increase in working capital of the business, right? Now, we go back to our first question that we had seen. If current ratio has gone up, that must mean that CA minus CL will also have gone up. That would mean that working capital would also have gone up. Working capital going up would mean cash and cash flow would have gone down. And remember, stock prices are valued based on discounting of the cash flows. You are discounting the cash flow to calculate the stock price. So if the cash flow goes down, automatically your share price should react negatively. The share price should also kind of move down. So that's the second part, that because it is cash flow negative, an increase in working capital, and I'll add the term a sudden increase in working capital, which is unanticipated or unplanned increase in working capital, which surprises the stock market, will be stock price negative as well. What do I mean by stock price negative? It will negatively impact the stock price of the company if there is a sudden jump in the working capital because it is cash flow negative, right? And if you have not planned for it, you will be running around at that point of time in the business trying to figure out where do you raise cash from. That's the nature of working capital and why working capital becomes important. Now, we do need to, however, address the divergence that we get into these two, and we will address that in a subsequent section pretty soon, right? We want current ratio to be higher, but as current ratio goes up, we do realize that it could, in a real world, be negative for the cash of the company. And that would result in negativity around the stock price of the company as well, right? So that's broadly in terms of how do we dip working capital and how do we calculate working capital. Let's just summarize whatever we have said so far. Now, current assets are assets which will generate cash in the near term, right? However, till such time, the cash is tied up in these assets. We just saw that if there is a receivable, it will mean that some cash inflow expected by the business has not yet materialized, right? So it will block that cash for that period. Inventory, if it is not sold, will also hold up cash. That will also block cash. If I extend an advance to my supplier, prepay any expense, then that will also tie up cash which could otherwise have been utilized. So current assets in general block cash in the business. This cash should have been released, but it has not been released as yet, right? Current liabilities, on the other hand, free up cash. Current liabilities release or free up cash. Why is that? Is because what kind of current liabilities are there? Account payables are payments which are due for supplies received. Now, if you have not paid, that money is available with us, correct? Similarly, you could have other scenarios like customer advances. If a customer pays in advance, that's a current liability to us, right? But that gives us cash. That gives us cash, right? So essentially, that is how we define working capital in terms of what is CA minus CL. That's how the definition comes. Otherwise, if we were saying that it is the money needed for day-to-day operations, then we should have calculated the operational expense and tried and calculated the data based on that, right? So when we go back and look at what is the working capital scenario, if we say that it is money needed for day-to-day operations, we should take some measure of expenses and find out what is the daily expense. But that's not true. It is the money that needs to get funded, and that is why we need to find out how much money is actually needed to be funded. That's the money that is blocked in the business, and that will come from how much current assets do we have and how much current liabilities do we have. At this point of time, remember, we have assumed that current assets are non-cash current assets. So we have not really included cash in our discussion anywhere. We have assumed that let's keep cash aside for the time being. We want to first find out other current assets, all other current assets other than cash, minus current liabilities is what is the amount that is blocked in the business, and that's what needs to get funded, and that is what my working capital requirement is, right? We have used this definition, we have established the definition that this gives an idea about what money is blocked in the business, and because it gives that idea of what money is blocked in the business, it is what is working capital that needs to be funded in order to run day-to-day operations of the business smoothly, right? That's how we define working capital. Now, the next question that comes to our head is what is an ideal number? Should it be positive? Should it be negative? Or should it be zero? Right? So that's the next question that comes to our mind, that what is an ideal number for the working capital of a company? We discuss that in our next section.